Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host Neena Mishra. My guest today is Matt Bartolini, Head of Spider Americas Research at State Street Global Advisors. We're talking about the best investment strategies for 2021. Matt, welcome back on the show.
Thank you. Thank you for having me.
So let's start with the recent market action. 2020 was a great year for stocks, despite all those challenges posed by the pandemic. And stocks continue to rise. They continue to move higher, despite recent riots and current impeachment proceedings, because it seems investors are focused on hopes for more economic stimulus, particularly after Democrats' victory in the two Senate runoff races in Georgia. And investors like clarity, including political clarity. So talk to us a little bit about your thoughts on the recent market performance.
Well, we've seen a continuation of the market melt-up led by cyclical reflationary segments that have been largely battered for some time as a result of sometimes long historical patterns. Think about value stocks over the last decade have been quite hurt. But even in the near term, just in 2020, the dual headwinds of election uncertainty and a vaccine timetable, those were largely removed in November. Since then, prospects for higher growth have propelled those value-oriented names, some like small caps, financials, energy. But we've also seen an uptick in international emerging market exposures pretty much in the last 3 months, where emerging markets, as well as broad-based EFA developed ex-US equities, have outpaced the S&P 500. Now, credit markets have also rallied, and high-yield spreads are basically around 360 basis points, which, if we look over the past 10 years, that's in about the 17th percentile, so extremely low from a credit spread perspective. Now, naturally, while those sort of reflationary cyclical risk assets have rallied, we've seen defensive assets like gold and treasuries sell off. Now, all of this strong performance where cyclicals have outpaced defensives, and even when we look at it from sectors, right, discretionary has outperformed staples from a consumer perspective. Energy and financials have some of the best performance in the last 3 months. Now, this performance has not been in lieu of reduced volatility. The VIX remains above 20 and continues to have its consecutive day streak intact, where basically over the last 230 consecutive days, the VIX has been above 20, which is more than more days in the last 8 years combined of being over 20, consecutive or not, for the VIX index. And this is due in large part to continued rising case rates. And even though we have a vaccine timetable, that vaccine rollout is extremely uneven. And I think that's two aspects that are going to continue to be with us in 2021, but hopefully get resolved later in the year. So I think the recent market performance that we saw really over the last 2 to 3 months is likely to continue going forward, where you start to see a sort of rotation to inflationary trades, but still juxtaposed against heightened volatility.
Yeah, excellent. And I remember that you had recommended investing in small caps, value, and emerging markets when we had you on the podcast last time. You said that once we have more clarity on the political situation after the elections and better clarity on the vaccine rollout, then these areas will perform well. Now, what can investors expect from 2021? And we know that earnings season is now upon us, and most of us will be interested more in the first and second quarter guidance than in the actual results. What should investors expect from the market this year, and which areas should they focus on?
Yeah, so as we were discussing before we started recording for this, it was kind of like, new year, same problems to a degree. So under that vein, I'd expect more of the same to a degree that we have had over the last 3 months. I would say, though, however, the Georgia Senate runoffs, where the Democrats have taken control of the Senate, we are likely to enter into a sort of Goldilocks period of fiscal policy. There's enough of a majority to get stimulus done, probably on a larger scale. It has already been proposed and certified, but there's not enough of a majority to make wide sweeping tax policy changes that could have a detrimental impact to certain firms' earnings growths and restrict overall spending, right? So I think there's this sort of idea that we have enough. There's enough control from the Democrats to encourage expansionary fiscal policy, but not enough to make those policy changes. And then you add that from the statements from the Federal Reserve on keeping policy extremely easy, and then you have incoming Treasury Secretary, former Chair, Fed Chair Janet Yellen, who's expected to really champion what she has labeled extraordinary fiscal support. And that's setting really up a year where it's that, like I said, Goldilocks or overly dovish period. And that should support risk assets like stock and credit more broadly, because rates are going to be low, making bonds less attractive and really ushering in, it's already here, but this notion of there is no alternative, this TINA-like behavior where you need to plow into risky assets to earn a sort of real return for your portfolio. Now, with respect to bonds, however, I would expect rates to remain low, but moderately shift higher on the long end of the curve as, pretty much in the U.S. 10-year as growth and inflation expectations tick up. This should lead to a steeper yield curve because the Federal Reserve is likely to keep short-term rates low. So I think that's really sort of the baseline expectation, and somewhat we witnessed over the last 3 months or so. I think one thing to sort of recognize, though, is we won't get meaningfully higher rates from where we are now, which as of today are about 110 basis points in the 10-year, because we still have a negative output gap, meaning we are still running well below trend output. So we're not going back to normal for some time. We need significantly strong growth in 2021 and 2022 just to get back to trendline growth. So I think for those reasons, rates will rise slightly, but be capped by the strength of the output and the impact that inflation will have a hard time sort of meaningfully and persistently increasing above 2% because some of these deflationary technology forces that are still around.
Excellent. So obviously we will see some release of pent-up economic demand with the wider rollout of vaccines and a large stimulus package. So in this environment, should investors focus on cyclical value or secular growth?
Well, in our view, it's a barbell. I think value has staged a bit of a comeback over the last 3 months, as we discussed earlier, particularly as the vaccine news was released. Yet there were secular forces for specific areas of the economy that are likely to drive certain segments focused on innovative technology within healthcare, document storage, clean energy, intelligent infrastructure, cybersecurity, pretty much as our lives will continue to be, conducted in a digital economy rather than a physically connected world. And I think, the argument should less be framed about, value versus growth within this paradigm, largely because, as we classify innovative strategies or innovative companies, they're not classified by styles. Our broad innovation fund only has roughly about a 40% overlap to broad growth exposures. So that's why we're really talking about this idea of barbelling, not value and growth like your traditional space, but just trying to seek out cyclical value exposures, the ones that are really tied to this type of recovery that we're likely to have, because it is going to be a bit of a balance as we balance the recovery, but also the secular change. And that's why we talk about the barbell of cyclical value and secular growth, because there's certain elements that are going to benefit in the near term around, a reflationary environment, a potential rebound of the economy, an uptick in economic growth, while the latter is likely seeking out areas that are benefiting or potentially benefiting from the systemic societal change we have witnessed, where new behaviors have been ushered in and have basically been brought forward from something that we have been talking about that could be about, say 5 years down the road. But now intelligent infrastructure, for example, is much more prevalent within our society, and that's unlikely to change, particularly given the need for more contactless interaction and more intelligent forms of communicating.
Now, I wanted to talk about an area which has seen a lot of interest, clean energy. Now, clean energy stocks and ETFs, they were among the top performers in 2019, again in 2020, and then the blue wave really lifted these stocks and ETFs because the Biden administration is expected to focus on climate. That would be one of their biggest priorities from day one. And I saw that your clean energy ETF, ticker symbol CNRG, Spider S&P Can Show Clean Power ETF, that has gained about 190% over the past year. So do you think clean energy ETFs and stocks can continue to do well?
Yeah, I mean, I think that market has a few tailwinds behind it that can help propel it forward over the next few years. And I think largely there's sort of three of them. Some of that's the societal behavior we talked about earlier, and it's really about how we're consuming energy, where the consumer of energy has transferred from the corporation to the individual, with so many of us working from home, and that'll speed up the demand for more cost-efficient sources. And we've seen wind and solar costs decline by 40 and 80% in the past decade, respectively. Secondarily, as you mentioned, policy responses. According to Biden's transition website and the statements he's made, climate change is one of the four priorities that his administration will focus on from day one. Calling for carbon pollution-free power sector by 2035. As well as pledging a significant amount of dollars towards clean infrastructure technologies, but also public transportation and electric vehicles. So I think that's the second part, right? There's a policy shift that's going to support it. And then third, irrespective of Biden's climate agenda, that's going to accelerate some of the growth that we've already seen beforehand. Even during the more pro-fossil fuel Trump administration, their shift to renewable forms of energy had already begun. The U.S. energy, the U.S. renewable energy consumption growth rose for the fourth consecutive year in 2020, and it exceeded coal for the first time on record. So we were already moving in this direction. And I think the two things about the pandemic and our behavioral changes will amplify that, but also the policy shifts, where we're going to have a more focus on renewable forms of energy and cleaner sources of energy as well.
Another area I wanted to talk about is bank stocks and ETFs. They have also seen a lot of interest in the past few weeks. And in fact, they have significantly outperformed the broader market. And that came after a long period of underperformance. And I saw that your bank ETF, Spider Bank ETF, ticker symbol KBE, it is up about 37% since the November election versus S&P 500's gain of about 9% during this period. And this rebound actually began with the news of very effective coronavirus vaccines. And then, of course, the anticipation of a large fiscal stimulus also benefited these stocks and ETFs. And we have seen the yield curve steepening in the past few weeks, and that should also benefit bank stocks and ETFs. Talk to us about your outlook for bank ETFs now.
Yeah, so I think this goes back to talking about that cyclical value exposure. So not just broad-based value, but what might be tied to sort of an expansionary environment. And when we look at the checklist, we want to say, okay, do you have a positive relationship to the movements in the 10-year yield? Because our expectation is that the U.S. 10-year yield is to increase based upon higher expectations of growth and inflation, but also because of large-scale stimulus plans. And as we have showed in previous reports, but also is evidenced by the return structures, banks have a higher correlation to U.S. 10-year rates than most other assets, basically about a 55% correlation historically. So that positive relationship to the yield is there. Secondarily, there's higher expected growth in the market. Banks have higher growth than what is expected over the next for this quarter in Q4 reported, but also in 2021 and 2022. And that's a benefit, right? So when growth is more widespread, you will look for more undervalued assets because you're paying for a cheaper multiple. And that brings me to the third point, valuations. Even with the run up in prices and returns that you mentioned, valuations for bank stocks remain quite constructive, still relatively in the bottom, I think 15th percentile historically. So those three things we always look for the checklist in terms of identifying these cyclical value exposures that may be able to benefit in an expansionary recovery that we're hopefully, standing at the precipice of.
Banks definitely look attractive from valuation perspective, and big banks will kick off the earnings season later this week, and investors would definitely be watching results and guidance very closely. And the Fed recently allowed some big banks to resume share buybacks, so that would also probably help these stocks. Probably we'll look for those announcements also in these earnings calls. Uh, Now, I wanted to talk about some of the trends which have been accelerated by the pandemic. Areas that you mentioned earlier, like cloud computing, cybersecurity, digitization, e-commerce, electric vehicles too. So you wrote recently that the pandemic has pushed the adoption of these behaviors by a few years, and overlooking these innovation trends may reduce a portfolio's opportunities for growth. Talk to us more about that.
Yeah, I mean, part of it is if we look at the broad-based S&P 500 exposure, while it's broadly diversified, it doesn't really have access to a lot of these disruptive and innovative companies that at the forefront of how our society behaviors have changed. When we look at our broad-based innovation exposures, there's roughly about a 35 to 40% overlap to the S&P 500, and that's because disruption happens further down the cap spectrum. So if you're not focused on some of these thematic exposures, you do not have specific allocations to firms that are innovating within, say, clean energy or document storage or enterprise collaboration. And that can be a detriment to growth, particularly as the old economy transfers into the new economy. And we can look at this even just by decomposing a broad-based selection of thematic broad innovation ETFs. The expected EPS growth of that combined portfolio, say I think there's roughly 20 thematic ETFs in the U.S. listed industry, different classifications, different methodologies, but overall they're still focused on broadly innovative firms. And the expected EPS growth over the next 3 to 5 years from consensus analyst estimates is much higher in the market as a result of being able to, or as a result of being the firm operating within something that is, part of these behavioral changes. So I think that is one way we like to showcase the potential for growth that these firms may offer. I think also the performance trends we witnessed in 2020 when these societal behaviors really became augmented is also reflective of the potential. Now, obviously, it's just 1 year, and there's a lot of things that happened last year, but I think we can all agree there was an inflection point of behaviors, and particularly an inflection point of innovation. And last year, out of the 23 ETFs that had over 100% return, 20 of them were listed as thematics, as we identify them in the industry. So I think there could be some detriment if you're overlooking this segment. Now, obviously, you wouldn't allocate 100% of your portfolio or nowhere near that, but I think you need to ensure you have some form of exposure as the economy changes because broad-based exposures are unlikely to keep up, just given how disruption is happening further down the core and irrespective of any specific style.
Very interesting. And talking about thematic ETFs and outperformance by thematic ETFs last year, I noticed that your Kensho Smart Mobility ETF, ticker symbol HALE, that has gained over 100% over the past year, and your Kensho New Economies ETF, ticker symbol KOMP, that is up over 70% over the past year. Talk to us about these two ETFs and how they are positioned to benefit from the trends that have been accelerated by this crisis.
Sure. So KOMP is a broadly diversified fund focused on firms at the forefront of innovation. We identify different areas of innovation, whether it be intelligent infrastructure, future security, space, and then allocate appropriately. So it has roughly about 400 names within it. So again, it has the depth of innovation that you would want to ensure that you're able to capture, what is really a sizable systemic change in our society that is creating new industries and really augmenting old ones. So that's KOMP. It's that sort of broadly diversified innovative fund. HALE is a subcomponent of KOMP. This one is really focused on smart mobility, smart transportation. So think autonomous vehicles, ride sharing applications, and things along those lines, which I think can uniquely benefit potentially in a new economy where we have this desire for more contactless interaction and autonomous delivery, particularly as we have a shift towards more online retail shopping and the ability for potentially autonomous trucking to handle that last mile, because technically it's really predominantly on large highways where the routes are less sort of variable from that perspective. We've already started to see some approvals come through from the FAA with respect to autonomous drone package deliveries. So I think there's movement in that space. And I think what's also unique for Hale is, as a result of this shift, we saw a concerted amount of inflows over the last 6 months. And I think within 1 month, there was almost inflows on almost something to the degree of 60% of the days. And it was from smaller retail investors based on the trading patterns we saw, which is really constructive for me, because I think one thing in 2021 that hopefully, say, thematic ETFs can potentially solve for is reducing this gamification investing craze that has led to a lot of individuals to load up on single stocks, because not all firms will innovate at the same pace or be able to participate in the evolutionary change in the same manner or really have the right stuff. And as a result, when you target these innovative themes, I think ETFs and funds where you can mitigate some of the idiosyncratic risk may be more optimal for an individual investor, because you're able to participate in the change, but you're not able to, sort of make a single stock mistake by picking getting the theme right, but the stock call wrong.
Another area which has seen a lot of interest of late is emerging markets. Emerging market assets, stocks, and bonds, they have seen a lot of inflows in the past few weeks, particularly after the positive vaccine news, because obviously once we have wider rollout of these very effective vaccines, then we will probably see reopening of the global economy and a nice rebound. So outlook for emerging markets has improved a lot, and we have also seen outperformance by emerging markets assets versus the S&P 500 in the past few weeks. Talk to us about your outlook for EM assets, and is there any particular ETF that you like?
The outlook for EM sort of falls along trade policy tailwinds and improving fundamentals, particularly within Asia. So, broadly, emerging market Asian equities, and particularly Chinese equities. So from our lineup, that would be something like a GMF, which focuses on EM Asia, or GXC, which focuses particularly on just Chinese equities. So part of this, again, with a new administration, trade policy will be likely less combative and more predictable, and that could help soothe tensions in the region, where we continue to still see EM equities and EM Asia equities more broadly still below the levels they were from 2017 relative to the U.S. when that trade war began. Even moving further back, the U.S. equity markets have hit hundreds of new all-time highs. EM equities have still not retraced their 2007 high. So there's still, again, there hasn't been as much exuberance towards EM for quite some time. So those valuations there are also constructed. Meanwhile, as a result of the pandemic, where some of those nations have handled it much better than developed economies, estimated economic growth in the region is expected to be much higher throughout the next 2 years than developed regions. And I think that can also add some tailwinds to an EM Asia or particularly China exposure. And as you noted, we started to see some inflow. So that sentiment has already started to shift. But again, nowhere near what we've seen of interest into, say, developed U.S. equities.
Very interesting. Lastly, I also wanted to talk about the ETF flows. And 2020 was a great year for the ETF industry. And in fact, U.S. listed ETFs gathered more than $500 billion in 2020. Talk to us about some of the trends that you have seen from fund flows recently.
Yeah, so as you stated, $505 billion, that was a record year of inflows for the U.S. listed ETF industry. And a lot of this was driven by record-setting inflows into fixed income ETFs. Fixed income ETFs took in roughly about $212 billion of inflows, some from investors seeking defensive positions during the pandemic, some looking for income options, but also some participating from the the Fed policy decisions where we saw massive inflows and record-setting inflows into investment-grade corporate high-yield ETFs. But I think largely those fixed income ETFs also represent the desire for liquidity. Bond ETFs were able to produce and provide some of the liquidity options during some of the most sizable downturns that we saw in 2020. And we started to see greater adoption of fixed income ETFs as these liquidity tools because of their exchange traded nature. We also saw record inflows into gold, largely as a result of falling real yields, as well as an uptick in volatility. Gold flows reached records as well. Sector funds took in their second most inflows ever for a year, and the most ever when you start to include these thematic sector ETFs. And I think that's representative of a dispersed market where investors were seeking either market hedges or tactical positions to participate in a really dispersed return environment rather than sort of indiscriminately just buying broad beta, because we definitely saw winners and losers emerge as a result of the events of the pandemic and the rally that ensued. So it was really a strong year for ETFs. For those that are typical strategic allocators, we saw low-cost funds do well. But we also saw the inherent benefits of ETFs providing market access, but also liquidity tools to a broad set of investors. And that led to record-setting trading volumes, 32 trillion overall traded in ETFs in 2020, and then record inflows as well of 505 billion.
Definitely very interesting trends. That's all we have time for today. Matt, thank you so much for joining us.
Thank you for having me.
Thanks for listening. If you want to learn more about these ETFs, please visit the ETF section of Zacks.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcasts, and also make sure to subscribe. If you have any comments, questions, or suggestions, please email podcast@Zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.